The one true non-correlated asset. Man, I cannot tell you in my experience, which goes many, many moons, how many financial advisors task to design a non-correlated portfolio of various investing opportunities. So let's say we have international stocks, small cap stocks, high yield bonds, real estate investment trusts. We have this, we have that. Because when yin goes, yang goes the other way. When yang goes this way, yin goes that way. When one goes up, the other goes down. And in crises, everything is correlated. Everything. The exception is always, well, I'll share with you here in a second. You got to watch the video to hear. There's always an exception, though. And the interesting thing was in 2000, 2001, and 2, what was not correlated? Oh, man, such a beautiful day, by the way. Oh, look at that dark blue sky behind me. Almost a cobalt blue. Oh, look at that. Trees starting to bud. Oh, man, I love the spring. So the market getting killed in 2000, 2001, and 2, the only thing that survived was value stocks, large caps. I'm not sure if small cap value did. I just off the top of my head, I don't know. But large caps certainly did well. And we know that because the Wellington and Windsor funds and various other value-oriented stock funds, Investment Company of America, from American funds and whatnot, they did just fine. I mean, in 2000 and 2001, Wellington was up. Now Wellington has some bonds, mind you, but value stocks perform fine. It was the growth that got crushed. So everyone says, see, you need value stocks when the market goes down because they are non-correlated to growth stocks, or you need a little bit of both. Well, what happened in 2007 through 8 through 9? Well, everything went down. Small tech, large value growth, international, you name it, except government bonds. So then people say, well, you need government bonds to secure a non-correlated asset base because government bonds did not go down during the Great Recession. Well, fast forward till this time here, and government bonds got tanked too. Now, government bonds have been volatile as all can be, but you're not buying stuff. Yeah, I mean, so they've gone around, they've gone up, they've gone down, but they've gone down sharply and they've gone up sharply. The point about a non-correlated portfolio is that the ideal is that when it yings, you want to yang. When a portion of your portfolio yings, you want the other portion to yang. And that's simply not what happened in this Great Recession. Except for one thing, cash. Cash. Be it CDs or be it just good old-fashioned cash at the bank. Cash is an asset. I cannot stress this enough. People get on the Schwab Intelligent Portfolios because it keeps, quote, too much, unquote, cash. Cash is an asset. If the point about diversification is that you have asset classes in different areas, so that way you always have something that's doing something opposite of what the other thing is, having cash inherently makes sense. I don't understand why people get so, almost bitter about this. It's weird to me. I'm like, dude, I get it. You don't want 7% cash, then don't have a Schwab Intelligent Portfolio. But what are you going to do to give you the diversification that you supposedly are seeking? You have to have some kind of cash. It's that simple. Well, it's easy for you to say now, Josh. I've been saying this since I started this YouTube channel. I say it in this regard. You need cash, CDs, or Ginnie Maes. One of those three things. I would still argue Ginnie Maes are an acceptable diversification tool because Ginnie Maes are mortgage-backed securities. And what that inherently means is that they're 100% government guaranteed, just like a treasury bond. But unlike a treasury bond, Ginnie Maes are guaranteed backed by mortgages which secure homes. People who are losing their jobs are not going to refinance mortgages. Interest rates are going up, people aren't going to refinance mortgages. Interest rates are going down, people may refinance mortgages. And there is interest rate risk in this regard, but it's not at all in terms of principal risk. Now, will there be a time when Ginnie Maes, again, I'm just using Ginnie Maes mortgage-backed securities. I'm not throwing MBSs all in one fell swoop because I don't know what those other MBSs are, private mortgage-backed securities. I don't know what that is, but Ginnie Maes are not like that. So I would not sit here and say today, if you're looking for diversification, buy Ginnie Mae's to offset the ups and downs of the markets, because I don't know that Ginnie Mae's can't take it on the chin. Now, they haven't since 1980 when the Vanguard Ginnie Mae fund was introduced, but they could. I just don't know. Just because they haven't doesn't mean it can't. Cash and CDs, though, won't. That's a fact. The risk of cash and CDs are inflation. That's always, forever will be inflation. But that is different than having a diversified portfolio that says I need to have something that moves in opposite directions or non-correlated directions, because everything in the market is correlated in a crisis, I should say. Everything. And that is everything goes down. As we're witnessing now, as we witnessed in 2007, 8, and 9. That's just a fact. In a crisis, everything goes down. All right, so if you want non-correlated assets and you don't have cash, and don't tell me gold. Gold is not that. Look at gold, the spot price of gold. Don't tell me gold. If you're trying to stay non-correlated, the only thing you need that you can offer or have is cash. Everything else is correlated. Just keep that in mind. Do not overlook cash and say, well, it's boring. I'm not getting money. Well, you might not be getting paid on cash, but everything else is losing. So relative to other stuff, you're inherently getting paid. If I have 10 and you have 10, and you expect your 10 to grow to 12, but instead it grows to 9, and I still have 10, I got paid. Does that make sense? How did I get paid? Because I didn't lose. That's how cash works. All right, we'll see you.